My name is Kareem Manjawala. I'm a lawyer practicing in Nairobi and kind of doing M&A in the region. So what I'd like to do is first just set the scene really quickly, right? Some of you may have seen the EY report, PE in Africa 2014. There's a KPMG document on the same thing. Deloitte has released a recent report, and I'm sure, not to do any disservice to the Big Four, I'm sure Pricewaterhouse has as well. Okay, but the data is something like this. 2007 to 2014 across Africa, 249 exits, 40 in 2014, which was a record year, starting from 2007. West Africa and East Africa have more exits and more activity compared to Southern Africa and North Africa. I guess anecdotally that makes sense as well. You know, your key thoughts and challenges when it comes to your investments around the question of exits.
For us, the big challenges for exits is really that we've chosen a segment which where exits are a bit challenging in itself. As we invest sort of on average, or have been investing on average about $1 million in SMEs, and from really early stage to a bit later stage family businesses. And where it typically takes a bit longer to mature the businesses and that they're ready for exits. Where a lot of people say that, you know, you should then be able to sell to the next, to pass the parcel. We've done one exit out of the 9 companies that we've invested in, and there we passed the parcel, but it was to our co-investor. And it was a really good exit.
We've been doing this for quite a while. When we think about it, from the first exit that we had in Acacia, which was in the late 1990s, and the one key lesson that we've learned is that if you want to have the returns that make a market attractive, I think you have to be targeting for trade sales or strategic sales. Because in our experience, those have delivered the better return. So in terms of the strategy that we have as a fund right now, is that we are targeting businesses that we can either deliver control to a large regional champion or a multinational, if that be the case.
We have 6 assets, and we exited 2 of the companies last year. And one of the key things that we learned is around, and I guess part of the challenges, is the ease of exit depends on the quality of the company. So for one company, we actually sold it to Actis. What we found was that the company had a powerful technology, but with most powerful technologies, you find that they have multiple uses. So nobody was really interested in a business with multiple uses, so we had to spin off some of the entities and focus on one core business, which was quite relevant to emerging market private equity funds, and also trade buyers, and Actis ended up buying that company. And this one was a company that was a bit later.
But I wonder, I don't think, and correct me if I'm wrong, but I don't think any of you have exited, strictly speaking, through an IPO, right? But maybe you could just share some thoughts, if any of you have some thoughts on this issue.
Okay, we haven't exited through an IPO per se, but what we've had is what we call as PIPE transactions. So it's basically a private investment in a public equity business, where I guess the route for exit is pretty well defined. At least you have some liquidity from the markets themselves.
My question to the panel is, to what extent are we seeing businesses in East Africa or in English-speaking Africa talking to potential buyers from the French-speaking investment community, or better yet, Chinese?
Anyone want to take that?
Well, actually, just point out that the transaction that you did mention, Brookside, was a partial exit from us. So yes, we are engaging with all sorts of parties. And also just, Danone is a partner that we know very well. We have done a transaction with them where we acquired a business in West Africa, Fan Milk International. So it's a party that is well known to us.